Good weekend, everybody. This is a silver update using freestockcharts.com and the code XSLV. And we have this monstrous red candle, and there's numerous on the silver charts to the downside, which brought us directly down towards this moving average, which is the 200-day moving average. If we take the Fibonacci from the highs from up here towards the lows, it looks like it is breaking below this Fibonacci level. On the 1st of July, it broke through it. On Friday, it pierced above it and then closed below it at levels not seen since June, where the stock market are at levels not seen since last fall. With that being said, I noticed there is a noticeable difference between the exponential Fibonacci and the linear Fibonacci. The Fibonacci I shown you was linear. The bottom on February was 1465, and this top is 1985. So if we take the top of 1465 and 1985 as the top, we'll get some Fibonacci levels on the exponential side at 1768 and 1645. So the 1768 we will write in here, and that should give us an area where we should encounter some support, and that is exactly where we are within this level. The other one was 1645, and we'll put a line in for that Fibonacci. If this level gives in, and of course this trend line and the 200-day moving average, which is where we are at, gives in, then this becomes the next level of support. And this 1770 area is massive, for it was perfect resistance by a penny on the 17th of September of last year. It was the resistance level that it held for the most part of October. It pierced above it in November. It tried to find it as support. Instead, it was resistance on its pullback, breaking above that area at the start of the year, and then it had its massive selling in the earlier part of the year. The resistance was perfect on the 10th of March. It got above it. Support, 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 support. Support, 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 support. I said it 5 times. The more often support is tested, the more often it has a chance, or the better chances of which is that to be taken out. This is the second support test of the 200-day moving average. And if you look at this little area, we are developing, or we're almost finished the development of a head and double shoulder pattern. I've never said the head and double shoulder pattern until now, but you have 2 shoulders in here. This is the head, the first shoulder, and now this shoulder, which is a little bit higher. So it's looking a little bit bearish on the intermediate term trend. Now, when we adjust this to a longer term perspective, the weekly chart, for example, it's in a very bullish trend still, as this trend line, which started back in 2009, has not given in, at least as of yet. And the highs were 2135 back in 08, and the lows were 846. So if we put in 846 in for a low, 2135 in for a high. If you want this spreadsheet, there is a link in the more information box. It is a free download. This gives us Fibonacci, we'll say 15 and 12 as easy rounding numbers. So therefore, this, we'll put in a line in here and switch this up to 15. And this is the key trend line. It was already support in here. And on any breakdown, then that looks to be the spot which will find support. So on the weekly chart, anything above 15 right now is considered bullish. As long as we're above this 15 level, it seems as if we're in a bullish scenario. Between this 12 and 15, that's more of a neutral state, and below that is bearish. And that's on the weekly chart. And on the shorter term chart, say the hourly chart, we are actually bearish right now. And that we'll get to that in a little while. If we take a look at this at an extremely long-term point of view, we'll say the 9-day chart. When you have a move which brought it down to fire sale prices of about $4 per share, and it has a beautiful trend. This was the trend line that was broke in 2008, and it's been used as resistance on a few occasions. It's giving me bullish signs. When you can go down below these levels and then recoup yourself back towards this range, to me, I think that is quite strong. Now what we're going to do is long-term Fibonacci. And the Fibonacci that we're going to do is upside Fibonacci, and that is trying to calculate moves towards the upside. And the points that I like to make are the points I like to make is this high here on this double top. This is a double top from 2004 to 2005 at roughly $8 per share. And that gives us a bottom level of about $4 per share. Simple math. The 161.8% level was taken out very easily back in 2006 with immediate resistance at the 261 level. After it makes a correction through price, it comes back down to this 161 level at roughly 10.5, finds resistance again, and then when it broke above it, it went right up to this 423.6% level. And when you have panic in the market like we did in 2008, a lot of times these Fibonacci's, it can just go right through them. It could be panic upside or downside. This, or at least fear to the upside, whatever you want to call it, emotion. The emotion of trade, when it's super high, can just burst through these Fibonacci's. And the emotion got it through above this 10.5 level pretty nicely, and the emotion did the same thing in here. On the way up from the bottom, this level did find resistance again. Perfect resistance in February. It managed to get above it. The pullback in this February here was support. And we've yet to have had a second test of this 423 level. Now what I'm going to do is show you some math on the Fibonacci levels. So say we'll just change the fonts in here so they're nice and easy to read. So say we have a level of 4 as a bottom, and we have 8 as a top. Now the difference is obviously 4 points. Therefore, the first level is 161.8033%. So we'll put that number in here. To calculate what the upside numbers happen to be, we have 161, 261, 423. The method that can be used is to take the previous number and multiply it by 1.618033. And that gives you 2.62. Therefore, what it does is it takes the difference of the number, so 161 multiply 4 from the bottom, and that bottom is also from 4, which is where you get the 10.5 number. On the second level, it got us to 1447 or so, as we can see right in here. That's about 1447. On the second level, we'll just do a copy and paste. That gets us to the 4.24 level, which is 423.6%. In fact, if we adjust this to show a bunch of percentage with a bunch of decimals on here, we'll do 5 decimals. You can see how it's 423.6. Therefore, the next key level, which is the 685.4, gives us a price target towards 31.42. And if you really want to have some fun and just paste a bunch of different cells along the way, you got a price objective that goes to about 50, 75, 120, 190, a little over 300, almost 500, 800, and so on and so on. Of course, this is going pretty huge as far as getting to 5,000. And Webbot, if you've been listening to Connecting the Dots channel or anything else in which Webbot is stating where silver is most likely to go, they're saying like $400, $500, $600 per ounce. And heck, I've put a sign in many past videos of silver going to 1,000 per ounce for 2 reasons. Reason 1 is the inflationary trade, and reason 2 is because of its actual physical demand based on its actual physical supply, which is the reason why I think not only can it be a hedge against inflation, but I still believe the physical metal itself seems to be potentially the best investment in human history. But as far as getting to 5, 6, 7, 800 anytime soon, maybe in 2012, I think it's possible next year, but realistically, I think that hitting this 31 level this year is likely, or it's potential. Extremely unlikely we're going to get to the 48 level. You never know when you have these big moves. For when we had the breakout of this $8 level that went all the way up to 14, that's a gain of almost double. So therefore, if you were to break the level of 21 and pretty much double it, then that's going almost to like $40 per ounce. And therefore, you can have big volatile moves within that occasion. Now what we're going to do is we're going to take a look at this on the shorter term time frame. We're going to use the ETF SLV. If you're buying SLV, you are not getting silver. It's not the real silver. It mirrors the price of silver very, very well, but it's not silver itself. For example, if you take a bullion silver coin, a Maple Leaf, an American Liberty, heck, even the old silver quarters and dimes, they can be used to make solar panels. Now, if you take your contract of your silver ETF or your COMEX silver, good luck making a solar panel with that ETF. And if the inventories of silver are much lower than what they actually state they are, meaning a fractional reserve system, that can cause many significant problems down the line. And just something to keep in mind. Now, we've already seen the daily, weekly time frame. I want to use SLV to mainly show what we're seeing on the hourly chart. As far as the Fibonacci upside, or the Fibonacci that's exponential, the closer the percentage moves are, the less that it's going to mean. The Fibonacci from this high to this low has already broken below this 1778 level. So therefore, on the intermediate term time frame, we are in a bear market. We're also at that key longer term support level right here, which is that Fibonacci, which I shown earlier, which is in coordinates with the 200-day moving average, which can give you a reason for buyers to come in. After all, you have this big selling in here, you stabilize, market goes higher. You have the big selling down here, and the markets go higher. Now what you had here is the buyers, instead of waiting for the levels to be well below 17 3/4, they took in the aggression to put in the orders in here, but when it stabilized within this level here, it took a big, huge turn to the downside. Therefore, people weren't willing to be buying at this level. And it's not the regular people that are buying these level or buying the SLV and the COMEX. It's the institutional traders. You may have heard of JP Morgan who have shorted this market. So therefore, if the people are not able to get this market a heck of a lot higher or a heck of a lot lower because you don't have the money to do so, even if you are the likes of someone like Donald Trump. He doesn't have the money to make silver go way high to the upside or downside because of the institutional buyers. Therefore, thank you for watching and have yourself a great day.